Hello and welcome to Econoday Unplugged and what will be our last podcast in 2023. It's Tuesday, the 19th of December, and on today's edition, we have Terry Sheehan on the US East Coast, Max Sato in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. While one way or another, this year has produced the usual, perhaps inevitable, string of surprises for financial markets, not least a global economy that refused to slide into recession expected by many, or in particular, inflation, which both rose and fell faster than the forecasters predicted. These two factors alone have done much to ensure that 2023 has been an especially volatile period for asset prices in general. So in today's podcast, we thought we'd have a look at which of these forecast errors have had the most important impact on international investors. So let's get on with it then. Stateside, Terry. Well, I guess the one question I would ask you about is, whatever happened to recession?
Beats me.
Good answer. Start where we mean to go on.
Well, it really has been interesting that all the concerns about the rising interest rates ruining economic expansion just don't seem to have come to fruition. So, for the U.S. at least, the underlying trend for the economy seems to be this right around 2% growth, which is a nice moderate pace.
So is that, well, let's rewind what I was going to say, but is it fair to say now that after last week's FOMC meeting that the long-awaited Fed pivot has finally taken place now?
Yeah, I think that we have seen the peak in short-term rates.
And I think it's also fair to say that there's been a fairly significant shift in terms of the way the actual FOMC itself sees interest rates moving in 2024, certainly compared to where we were just a few months ago anyway. So I think, when we're talking about overall surprises, do you think the Fed's really been caught out quite a lot as well this year as well by developments?
Well, I think the thing that really caught the Fed out this year was the problems back in March with the failure of Silicon Valley Bank and the associated fallout from that. There really has been a lot more talk this year from Fed officials about things like maintaining financial stability, which seems to be the story behind the increase in interest rates over the last 18 months or so. But higher rates have not ruined the economy. And in fact, I have to wonder if they haven't in some ways helped a little bit in terms of making financial decisions that are based less on low cost of borrowing than on the need for borrowing.
Interesting. I was going to ask you about the Silicon Valley Bank. What was back in March, wasn't it, when that went belly up, so to speak? Do you think the Fed was caught unawares by that, or do you think clearly it had a major impact on financial markets? I'm just looking at the bond market, equity market, or whatever. Do you think the Fed was alert to what was going on there, or do you think they were somewhat surprised as well?
Well, if you look at their reports of it, they were aware that there were problems, but they did not respond as quickly as they should have. And yes, they were caught unawares, partly because just the infrastructure of the financial system now means that these kind of problems are going to emerge much more quickly than they used to.
Okay. Anything else in terms of big surprises from the US side during 23?
I think that Fed officials themselves have been very surprised by the fact that their anticipation of slower growth just hasn't come to pass the way they expected. I think they're actually a little bit surprised by how much inflation has improved overall. But I think they are still very, very cautious about bumps in the road ahead, as they've said.
It's going to be interesting, I think, certainly, so without preempting 2024, to see what kind of models a lot of these central bankers are going to use, since a lot of ones they've been using over the last few years don't appear to be working too well at the moment. Great, thanks for that, Terry. Canada, Max, I guess one of the features of the Canadian data during the course of this year has been the high proportion of positive readings on the Canadian relative performance index, I should say, the index Econoday puts together, looks at how forecasters have performed versus the actual data. So, I mean, I guess it's fair to say that the Canadian economy has surprised fairly consistently on the upside this year.
I think that's a fair assessment right now, but we also always have something downside risks from the nature, drought or flooding or storms. So and then for the past year, I think we've seen many labor strikes, both in the States and Canada. I think labor unions see it as one of the best chances to ask for better working conditions and higher wages. So considering there are a lot of headwinds, the concerns about geopolitical risks, I think we've been doing fairly well.
Yeah, certainly looking at the numbers, that certainly appears to be the case. Bank of Canada, do you think on the whole they've have they called the Canadian economy correctly this year? Perhaps compared to other central banks, or do you think they were caught up by inflation, or perhaps they perceived a slightly weaker economy than turned out to be the case?
There were some ups and downs, and they could see some surprising numbers. But overall, they're not far off from forecasting GDP and CPI. But as the governor has warned us many times, that the path from 3% CPI all the way down to 2 target can be really bumpy.
Right.
It can. He said recently again that there's always a risk that the path down to 2% could take longer than everybody thinks, or there's going to be another crisis in supply chains or energy commodity prices globally. So they can't really declare a victory over inflation yet.
Okay, I'm sure that's certainly true. Okay, you say that on the whole, the Bank of Canada perhaps hasn't judged the economy too badly. Have there been any other kind of surprises which have moved Canadian financial markets this year?
Today's data was a little bit disappointing, but not huge. The CPI, exactly the same as previous month, November, 3.1 total. And the other underlying data is also didn't change. So that means, I think the BOC is right about saying the fight over inflation is not over yet, and they don't want markets and people to price in too much about the timing and the pace of the rate cuts next year.
Okay, fair enough. One last thing from me, which came as a bit of a surprise to me, but perhaps not to you. I noticed last week the central bank made some changes to the way it'll be announcing policy moves and the like as we go into next year. Any surprises there? And indeed, does it have any significance?
Are you talking about the frequency of news conferences?
Yep.
Okay.
That's the one.
I wasn't surprised at all, because the bank has been over time trying to make the process of policy making more transparent and try to talk to the public and markets more often. So I think it's a good policy to hold governor and Senate deputy governors joint presser after each scheduled meeting, which is only 8 times a year. So I think that's a good move.
Okay. Thank you for that. And before we let you go, let's go across to Japan. What do we got? Well, the BOJ, last of the major central banks to make their end of year, if you like, policy announcement yesterday. Any surprises there? Because we've been through, you've clearly called it right this year, saying don't really expect anything. But was there anything at the end of the year with these markets still looking for a shift away from the ultra loose policy?
I wasn't surprised at all. The statement was kind of a mirror image of the previous one. And going into the meeting, I would say, don't take, I think the markets was wrong about reading too much into the governor's comment and in his parliamentary testimony. Mm-hmm. He was asked about his policy plans or attitude or his hopes going into his second term next year. And he said, typically in the Japanese language, they don't say what the subject is, but he said challenging. But what he meant was they're not going to have to, they don't have to make a difficult decision of lifting rates or not. What he meant was when he took his job during the confirmation hearings last February, he said this is a challenging job. So he just repeated the same phrase.
Right.
He didn't mean anything about policy changes. So, and then I understand some market participants are looking at a rate hike in January, but he did tell reporters yesterday that there's not much data they can get before their next meeting, which is January 22nd, 23rd. And my call is still April 25th, 26th for ending the negative rate, but that can be the earliest possible timing because that's when they're going to get more information about what the wage hike rate is going to be in the next fiscal year starting on April 1st.
Right, as you said before. Okay, so no big surprises at the Bank of Japan. Anything else that's caught your eyes in terms of kind of any economic shocks?
Not much of an economic shock, but as you can see, Kishida government's approval ratings have been declining steadily and plunged this time because the series of revelations that the main political factions in the ruling party have been underreporting profits from holding fundraisers. And that, reflects the old type policy making and, all done by to make the biggest factions happy. So I think public is fed up with it now. And as BOJ people have always said, they don't get influenced by any particular events, political or economic. But I think at this point in time, especially before they can draft the budget for the next fiscal year, on the government side, there's no point in the BOJ to hurry a rate hike while, before Fed can cut rates. I don't think they really calculate those timings.
Right. Okay, brilliant. Many thanks for that then, Max. Right, let's go across to Brian. Well, China, I suppose, I don't know, is it just simply fair to say that for China and the economy, it's been a year of mainly downside surprises? Hello, do we have Brian?
Sorry about that. Yes, just getting off mute. But yeah, I think definitely the main factor that's been weighing on the Chinese economy has been the property sector downturn, which has continued pretty much all through the year. Getting out the start of the year, we were hoping that moving past the COVID-0 restrictions, you would get a strong rebound in the Chinese economy, but it's been just I think really impacted by what's been going on in the property market. We obviously track house prices every month, and it's just been in negative territory for pretty much most of the year. And also, it's very striking the property investment data that we report each month. If you sort of strip out the property sector, investment's actually been pretty strong throughout the year, but obviously when property investment is falling 8 or 9% year on year every month, that's just dragging down the total and just being a real concern, I think, for policymakers about how they try and cope with that. We've definitely had a few tweaks here and there in terms of trying to improve liquidity and trying to ease some of the restrictions on borrowing that home buyers can do, but it really hasn't had a huge impact to date.
Okay, in terms of sort of the policy side of things, as you mentioned, it's been perhaps a disappointing period for the recovery in China. Have there been any policy actions taken by the authorities which have caught markets by surprise? Because it seems as if they've thrown an awful lot of money at the economy in various shapes and forms. So have people been surprised by just how far they've gone down that road, or did they think, well, look, we're going to have to do that anyway?
No, I think it was broadly in line with what people had been expecting, and also broadly in line with some statements that the limited statements that we do have on the policy outlook from authorities. So, and I don't think it's been a major shift in policy to deal with the property market. They've been burnt in the past of trying to do too much to support the property market and sort of that creating imbalances elsewhere in the economy. So they're probably a little bit reluctant to adjust policy too much to try and support the property market. But so it's a fine balance that they're trying to walk at the moment. We do have some meetings going on around the end of the year and early in the new year that will perhaps result in some sort of shift in the policy, the policy direction that they want to take. But it's a little bit too early to call that right now. And I think at the moment it's just been tweaking things here and there to try and provide a bit of support to the property market.
Yeah, watch this space, as they say. Okay. Move to your immediate part of the world, then Australia. Indeed, let's put New Zealand in with that as well. What have been sort of the main shocks for financial markets to digest there?
Well, probably something that does fly under the radar a little bit, but has definitely been highlighted by particularly the Reserve Bank of Australia and to some extent officials in New Zealand, has just been the pretty weak productivity growth that we've seen extend for quite some time now in Australia in particular. That's been something that has really been highlighted by the RBA as one of the factors that explains why they have had to try and crush inflation with policy rate increases, whereas
Right.
obviously they'd much rather have a situation where we had strong productivity growth and we could actually then allow the economy to grow quickly and have real wages growth without concerns about the inflationary impact of that. And that's been really a common theme through much of the RBA discussion this year. They've definitely put out a few interesting papers just examining the causes and potential solutions to this slowdown in productivity growth. And I think that's just really a major challenge for for governments, for businesses, and for basically consumers in Australia as well. It was already slowing down before the pandemic. The pandemic obviously had a huge impact on it, and as we move past the pandemic, we just haven't really seen a very noticeable improvement in that weak productivity trend in Australia.
Yeah, it's interesting you say that, because I think, to be honest, it's pretty well reflected in Europe as well. It does seem to be there's some longer lasting COVID effects perhaps than people originally thought would be the case, and productivity numbers, if I can say, particularly in the UK, have been fairly disastrous and a major worry for the central bank. Yeah. Okay. Anything else indeed, either be on Australia or New Zealand, different from what you've just said, or indeed the rest of the region that kind of been the main things that financial markets have been taken by surprise?
I would just mention how well things have generally gone in India. It's been quite a strong contrast with the weaker growth in China has just been the fact that India's had a reasonably good year, and again it did last year as well. I think if you go back over the last 2 years, it's outperformed China's economy pretty well. Maybe China's been growing sort of around the 4% level, and India's more around 2%. And there does seem to be sort of growing confidence about India's sort of medium-term growth prospects as well. We've had the IMF and some of the rating agencies and some of the the big thinkers about the longer-term outlook for the Indian economy, making sort of arguments that India's, in terms of its demographics and its level of industrialization, is kind of at a level where India was maybe China was maybe 20 years ago, and where when it went on its big strong period of growth. And so there's a lot of optimism around the Indian economy at the moment, and so that will be a challenge for the RBI to make sure that doesn't impact their short-term macro goals. But it is a positive signal that they're getting some of it right in the Indian economy. The government is doing quite a bit in terms of trying to and get some of the key infrastructure in place that they will need to be able to sustain this growth. But I think in the near term, we have actually had a pretty good year from the RBI in terms of managing the growth and inflation balance that they need to do. Their inflation numbers do get bounced around a little bit by food prices, but in general, they've had a pretty solid outcome for both a growth and an inflation perspective.
Okay, interesting stuff. Clearly one to watch in 2024. Thanks for that, Brian. Right, let's wrap this up then with Europe. What can we say here? Well, I guess after, in many ways, a surprisingly decent start, the Eurozone economy has had a pretty dismal performance over at least certainly the second half of this year anyway. Econoday's relative performance index has spent most of the year sub-zero, especially since the first quarter, meaning that on average private sector forecasts of economic activity have been far too strong. Now, like I guess most central banks, the ECB has been wide of the mark in its forecast, not so much on GDP, but particularly on inflation. In fact, just looking quickly at the GDP growth numbers the ECB came out with a year ago, so at the back end of 2022, they expected 2023 Eurozone GDP growth of 0.5%. As of last week's meeting and updated forecasting now expecting this year we're estimating this year, I should say, at 0.6%. So to be fair, they haven't done too badly there, although it should be noted that the quarterly profile is going to be well off what the bank was expecting. Back end of last year, they were maintaining that the Eurozone would avoid recession this year. To be fair, we haven't actually seen it yet, but to all intents and purposes, it looks as if it's pretty well there. If we do see a negative handle on fourth quarter Eurozone GDP, then that will be technical recession having arrived. And even if the fourth quarter isn't negative, there's every chance that the first quarter will be. In terms of inflation numbers, though, I mean, again, if we just go back to last year, inflation for 2023 was expected to be 6.3% and the core rate at 4.2%. As of last week, the headline now has been reduced to 5.4%, so nearly a full percentage point lower than expected 12 months ago. And the core at 5.0%, which is nearly a full percentage point higher. And I guess that really underlines both, the problems central banks have had forecasting inflation and indeed disentangling the headline inflation versus what's going on in terms of the core, the non-volatile components. A big surprise, I think, for the ECB and indeed certainly other central banks in Europe and perhaps elsewhere, has been this apparent disconnect between inflation and the labour market. The jobless rate in the Eurozone has held down surprisingly low. I mean, the latest figures put it at 6.5%. And that's just a tick above its all-time record low. And in fact, it's been hovering, I guess, around that level pretty well all year. And yet we've seen the core inflation rate that's fallen more than 2 percentage points since it peaked in March time. So it's kind of left policymakers, I think, having to jettison some of their economic models. And I guess a lot of them scratching their heads as to how they're supposed to go about forecasting the key economic variable they're supposed to be targeting. That's especially true of the UK, where indeed they've had some, I guess one of the surprises, say from my side, has been the quality or the problems the ONS, the Office of National Statistics over here, has had putting out its economic data. The ONS has always had a good reputation for producing reliable statistics, but over the last few months, it's had to release so-called experimental numbers on the labour market due to a lack of confidence in the official data surveys. And that's hardly helped the Bank of England. But I mean, frankly, the bank itself has already admitted on their growth and inflation forecasts have been taken with a pinch of salt in markets ever since November 2022, when they came out and said that the UK would by now be in the deep and longest recession on record, which clearly has turned out to be about as wide as the mark as any central bank has forecast. It may be still that we'll get a downturn in the UK. Recession this year still seems pretty unlikely at the moment, but if we get a negative fourth quarter, then we could well get a first quarter downturn as well. But even so, the kind of recession that the bank was forecasting just over a year ago, we're not going to get anywhere near that unless there's some major shocks in the system we don't really know about. Other surprise, I think, for Europe, in some ways, perhaps you have a difference between what's been happening with some of the major industrialized countries and the slightly weaker ones. So the weakness in Germany in particular, I think people generally were anticipating 2023 to be a poor year for Germany, not least because they were more susceptible than a number of Eurozone countries to developments in Ukraine. And clearly, perhaps you can say the fact that the war's going on may have taken some people by surprise, perhaps not for others. But in any event, it certainly hit Germany hard. And the manufacturing sector there really has been hammered by, well, both that, but weak global demand in general. And it's still really not showing any signs of a recovery. But compare that with Greece. Well, for people with good memories, they may remember, if we go back to the 2007-2008 debt crisis in Greece. That was a time when there was much speculation that the euro currency could actually be pulled apart should Greece be forced to leave the currency. In practice, though, since then, the various policies they put in place have seen Greece become one of the shining stars of Europe, much to, I think, to many people's surprise. 2023 GDP growth for Greece in the EU Commission's forecast was expected to be 1.0%. They're now, as of the latest forecast, suggesting it's going to be up at 2.4%. In fact, the economy is performing so well that the government's now expecting a primary surplus on its borrowing in 2024. And that would be the first time we've seen that for some considerable while. And indeed, after 13 years, as of October, Greece regained investment grade status from its credits rating from the likes of Standard & Poor. All of which means that the Athens stock market, when I looked this morning, was up just over 41% on the year. So it really has been a remarkable period for Greece. Given if we go back a year ago, given all the problems in Europe and everything else, I don't think many people really would have anticipated one of the typical underperformers within the European Currency Union, to perform quite as well as it has. Switzerland, I should also mention, looking again at Econoday's relative performance index, it's been almost unique in the sense that the RPI for Switzerland has spent almost the entire year in negative territory. And otherwise, it means that the economists or forecasters have been consistently too strong in their projections of Swiss economic growth. Now, in practice, that's meant there's been less upside pressure on inflation in Switzerland and elsewhere. And it's also led to relatively less tightening by the Swiss National Bank. All that said, one of the other surprises, which perhaps shouldn't come as a surprise given its track record, but while most central banks seem to be quite happy to kind of guide investors ahead of their interest rate announcements, Swiss National Bank again showed it's still more than prepared to stir the proverbial pot by doing the unexpected. I mean, in this case, it was back in September at their monetary policy assessment, when with speculators looking for another hike after some hawkish comments from the central bank, the SNB duly went out and left rates on hold. And I guess if nothing else, the simple takeaway from that is never take the SNB, I should say rather, for granted. Okay, then. Well, I guess that's a quick run round and wrap up of some of the kind of surprises which have been caught investors and indeed central banks on the surprise side for 2023. And I guess, I suppose a look back through the year always raises a question, who would want to be a forecaster in the first place? But of course, without forecasts, we wouldn't have a consensus. And without that, the economic data can't drive the financial markets. So to keep up to date with what's expected and what actually happened for all the key data, just follow Econoday's global economic calendar. And with that, thanks to all for tuning in. And on behalf of Terry, Max Brand, me, and indeed the entire Econoday team, to those who celebrate it, have a very enjoyable Christmas. So that's it for us for now, but we'll be back early in January with some thoughts on what might be driving markets then. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.